All right, everybody, welcome. Good to have everyone here. My name is Andrew Benton, Managing Director of Kogo Capital and a fund manager with Secured Investment Corp. That means I manage our lending business, the day-to-day operations of Kogo, and I also am a fund manager placing investments in our funds. And right now our funds are focused on debt investments really across the U.S. Many of those investments come to us in the form of loans submitted by our brokers who come through our education channels. Through the Lee Arnold system of real estate. So today we're going to be talking a little bit about people, property package, the consistent underwriting framework that we use for looking at risk in the loans we make. What do we think about risk? How do we quantify it? How do we approve loans? Obviously, we're in the money business, and selling money, there are a lot of people who want that, so we have to have some way of saying no, and how much and where. So today we're going to run through that, and I'm going to run through how we process a loan file. Hopefully this is a good use of everybody's time. I'm certainly looking forward to getting into some of the behind the scenes, how we think about lending, and I'll take it from there. Let's see, is everyone in here? And we'll just give people another minute or two to come in. And I'm going to pull up my computer, and we are going to get going. I think we have maybe an hour or so here. We'll try and not have too much dead space. We'll just try and keep it dense and informational, and I believe the recording is available after the fact tomorrow. Okay, so let's look at a live loan. Okay, let's look at an actual deal. I changed some of the numbers in this deal, and we're going to look at it as if it's a real deal. So, okay, so here's how it works. When someone wants a loan from Kogo, or really any private lender for that matter, generally they have a relationship manager at that lending company. Today we have Joey Rush, who's our Director of Wholesale Lending, and for our brokers who want to submit a loan application, they contact Joey, they send him an email, and Joey's going to pretty quickly respond with some basic criteria. And I'm going to show you a copy of the email you'll get back from Joey when you reach out to him. So Joey will say hi, and maybe you get him on the phone, maybe just get an email, depends on whether you call or email, but say you email across, so he'll respond with an email just like this, and he'll say, hey, please send across an application for the borrowers, send me the purchase and sale agreement, and the budget, what's the renovation budget, send me an ID for the guarantors, send me the title company information, and hey, while you're at it, give me a contact for insurance so that we can get started on that. For our team here, we only want to spend time on live deals. That means projects that are under contract, and we need to be focused on those projects. So it's always going to be important as you're working with your clients to make sure that they have a real deal that's under contract. Otherwise, maybe you shouldn't be spending time working on it either, right? We only want to be working on live deals. So say you have a borrower, he has something under contract or she has something under contract, you reach out to Joey, and Joey is going to send across an email like this. You'll notice up here this is a link to loan application. So you will fill this out, or you will have your borrower fill it out. Let's see if this is going to pop up. There we go. You will get something like this, and you can put your broker information in here, put yourself as a broker, and then down here, fill out all the borrower information. Again, you can send them this link as well. Have them do this. Sometimes they want to fill out their social security number themselves. Once this gets sent across, it gets encrypted, it's all safe and secure. But they will keep scrolling down. They'll put in the loan amount requested. They'll describe the property. They'll put in an address and hit submit. Of course, you have to fill out all the fields. And then you will have an actual loan application in our system. And just to be clear, what happens there is when the loan application gets submitted online, it goes to my team in order entry. And order entry is where we review people, property package preliminarily to make sure it's a deal that we even want to work on. So you've had conversations with your client. They have something that you think is going to work for Kogo. You go through the effort of collecting their purchase and sale agreement, getting their renovation budget, You send across an application link, and within 24 hours of sending across that link, you should be getting that deal on my desk personally, where as a fund manager, I look at it and I make a purchase decision. I'm saying, hey, do I want to make a debt investment in this property? Do I want to lend on this? Yes or no? And the way I'm going to do that is I'm going to look at people, property package. And I'm actually going to pull up in a second an example of what information I'm going to be looking at to make that determination. But yeah, I've got my computer pulled up here, so I'm going to try and keep this pretty real. So say you send that over to Joey. What's going to happen is my team is going to submit something across that looks like this. For example, this was sent to me by Kim. She's our underwriter, and she's on the order entry team. And she's going to send across an email like this, and it's going to have, look, it has, so people, property package. We have people, borrower, property, where is it located, package, what's our loan amount, and what is our pricing on this. So this is let's take this as a live deal. So the first thing I do when I'm looking at a project, I know I say people, property package in that order, but I assume that people are going to check out because I'm an asset-based lender. I'm most concerned about property and location. So let's just pull up this property really fast and take a look. So the first thing I like to do is just get a good Google aerial and figure out where in the United States of America is this property located. Okay, there it is. It looks like it's just north of Dallas. It's in the DFW area. It's in Denton. And, it's a nice suburban infill location. Look at all these houses. This is, these are master plan communities. People are building 50 homes at a time. That's generally a good sign. Looks like over here there's some new construction as well coming in. But okay, let's focus on the subject here. Now that I've proven that, hey, this looks like an in-demand area and I understand how it's connected to the DFW area, someone who works here is definitely commuting, into Fort Worth or Dallas. But let's just look at it. Let's see if there are anything physically that I see on this property as I'm reviewing it that gives me any pause, because I want to get back to your borrower as soon as possible if I see an issue. For example, if this is a burn down and I see, just up front, I say, oh, this thing is half burned down, well, that might change the loan amount, right? We're going to be a little bit more conservative if they have fire damage, because with fire damage comes extensive water damage. Let's make sure we have the right house here. I was looking for 2905. It's 2908. I'm on the wrong side of the street. That's the even side of the street. Over here we have the odd side of the street. Maybe I'll get a mailbox here if I'm lucky and I can actually confirm my address. There it is right there on the ground. We can all see that. 2905. Okay, so 2905 Christopher Drive, Denton, Texas. Okay, looks like maybe late 90s ranch style brick home. Great. Now I am going to pull it up and see if I can get some data from Zillow. Zillow pulls their information directly from county records. Oh, look, there's even a listing photo here. So I can look at, okay, late 80s. So 1987, 1,400 square foot house, 3-bed, 2-bath. I mean, this is a pretty standard home. I like that it conforms to the neighborhood and all the other houses that I saw here. So we don't have a 3-story home that's 7,000 square feet in a neighborhood that has 1,400 square foot homes. No, all these homes look pretty similar. And so that tells you this is conforming. So yeah, on the property, I think this is really good. Another thing when I think about property, I always think about the rehab amount as well. So what was the requested amount here? Rehab budget, $30,000. Okay, so a $30,000 rehab, that tells me there's nothing major structural that they're changing. This is a light rehab. This is probably counters, floors, paint, maybe some new fixtures and appliances. This is going to be really quick in and out. I'll take a look at the actual budget. I don't have that prepared right now and pulled up, but I'll take a look at the actual budget and I'll see if they're doing any MEPs. That's mechanical, electrical, plumbing. Generally, those are major renovation items, and a budget would be much more if you're changing out rough plumbing or rough electrical or putting in new HVAC. This is good. So from a risk perspective, I'm speaking as a lender here, I like this. This is not very risky. This is an easy to execute rehab. And if this is a first-time borrower, if Jimmy Smith here is a first-time borrower, I can see myself getting comfortable with this kind of rehab because we're not asking him to go get permits to change the structure of the house, to remediate foundation issues. to remediate fire or water damage, to remediate mold. This is simply updating the aesthetics and listing this property. I would imagine Jimmy Smith in this example is in and out of this in 30 days, meaning we close on it. Within 30 days, he's completed the renovations, and he's going to be listed. Today's July 1st. He's listing August 1st. He's still going to hit the summer season. Incredible. So this is, from a property perspective, fantastic loan. I will talk about the people a bit. Let's see if we have any info here on the exact nature of this. So I would, when I'm looking at this, I would actually pull up a link to this loan application, and I would look at some of that information that was submitted. I'll just pull up here, and I would actually review things like so we collect social and date of birth so we can pull credit. I would look at the credit, and if someone has strong credit, I would just move on. I also want to see that he has at least $15,000 of liquidity in his bank account just to get started. On larger projects, we might need a little bit more than that. But just as a general rule of thumb, if you're brokering, make sure your borrower has $15,000 of cash in the bank so they have some sort of buffer, some sort of liquidity. Obviously, they're going to need to pay a down payment. They're going to need to pay their interest out of pocket every month. So as a lender, I want to see that they have a little bit of liquidity. Starting at $15,000 is a great rule of thumb. So that's people. From the people, I want to see credit. I want to see some liquidity. And then from the property, I want to see that it's a good, easy, single-family home, conforming in a neighborhood. And then from the package, that's our loan. So people, property, package. Package means loan. Let's take a look at the package here. What are we proposing? We're proposing a $174,000 loan with an ARV of $280,000. So I'm just going to be really simple. 174 divided by 280. They're telling me we are at a 62% LTV. So what I did is I took loan amount, divided it by their ARV, their after repair value, and I determined that my loan will be secured at 62% of the value after renovation. That's a secure loan. Generally, as a lender, I want to be below 70% LTV. So this borrower has some room. This is looking like a healthy deal. They're not maxed out at 70% LTV. They've got some wiggle room. Maybe they list it for 280, which is their plan, and they only get offering at 265. Well, very likely it'll still be profitable for them at 265 because they have enough room there. And I can tell that based on LTV. I'll just highlight some other information on here just so you guys can see. When I look at our deals as well, I also know, student and master broker. This is stuff that other lenders, that doesn't really exist in their ecosystem. But for us, because we have the Lee Arnold system of real estate, I'm going to see if someone is a student in LAS, if they've gone through our education. And they're kind of two levels of students, really. There's the broker certification, and then there's kind of master broker, and they have different benefits. And generally, master brokers have access to even higher leverage loan amounts because of the way we train them. So a master broker might be able to do something that's 95%, 100% loan to cost to their client, whereas somebody who's not a master broker might be lower loan to cost. That's really what that means, and that's why that's in here for me. I just want to make sure we're sizing the loan correctly according to the relationship we have with the broker. Ed Johnson, this is a made-up name. Probably lots of Ed Johnsons in the world. But my underwriter down here is giving me some info about the deal. And so we're saying north of Dallas, property looks pretty good. There was also a comment down there about the broker saying, hey, this is his first deal. He wants to make sure he gets it done. And that's awesome because we do exist in the business of 0 to 1. So we are here to champion our brokers and get them from 0 to 1. That means getting their first deal closed, kicking off their brokerage business, and especially sending deals our way. Although I do want to get into, let's see, so we talked people, property, package a little bit. That's right. And then I was going to explain a little bit more about what comes after this. So we've talked a little bit about the very first bit of the loan submission process. That starts with people reaching out to today. Joey Rush is our director of wholesale lending. People reach out to Joey. Joey gives them an email and says, hey, we need these few things. We need your purchase and sale agreement. We need an application submitted. We need the budget. We need an ID for the guarantors. Then we can get that loan into our system. Then Andrew's going to take a look at it. I'm going to personally look at it. I'll look at this information like you guys saw. I'm going to Google the location, and I'm going to make sure it's a good location. Now, actually, let's pause there before we get into the rest of the lending process, because we are going to walk through, so deal submission, order entry, kind of preliminary underwriting and processing and review and closing and funding, and then eventually the deal's closed, the broker's paid, and now our construction draw team is sending out draws as the borrower renovates the property. Like we'll walk through that. But right now I want to pause on something because I've been seeing a lot of submissions recently. Keep in mind, I'm looking at maybe a dozen or 2 dozen of these a day. I'm seeing a lot of draws, a lot of loan submissions right now where the properties are in rural areas. Denton, Texas is certainly not rural. This is right in the DFW Metroplex. Now, commuting from this address to, let's say, Fort Worth, it's probably going to be a little bit of a commute. Yeah, look, you're 51 minutes away. Let's see what the commute is to Dallas. All right, you're an hour from downtown Dallas. And I'm assuming someone who lives out here probably isn't commuting to downtown. They're probably working in one of these, kind of tertiary areas. Maybe they're commuting to Plano over here. Maybe they're commuting to Frisco. From Denton, you might be down here in one of these other markets. So what I would say is this isn't remote or rural from the standpoint of some of the things I'm going to get into in a second. But it is outside of DFW, but I'm still bullish enough on this market as a fund manager that I would offer aggressive, I would offer our best terms and pricing on something in this location. Denton's a great market. But why do I say that? Well, I did do this when I looked at this population change. I like to do a very quick Google search and just do Denton, Texas population change. Here we can see that Denton, Texas is experiencing rapid growth, a 24.5% increase since 2020, and it's a city with a population of 175,000 people. I mean, my goodness, what is that? So 0.25 times, let's just see what that is, 175. Are you telling me they added 40,000 people in the last 6 years? I mean, what a fantastic housing market to be doing business in. If you have, even if you have 10,000 people moving to a city, I mean, that's a lot of people that need houses, right? Here we have, wow, 24. I mean, that is amazing. Yeah, it looks like they had 40,000 people move to the city in the last 6 years. So that gives me a lot of comfort as a fund manager, knowing, hey, if we do this loan here at 2905 Christopher Drive, this is going to be a good deal for us, right? Like I have no doubt that the real estate is desirable, in demand, and people are moving there. I can tell that. Population is growing. So we just looked at something where there's a strong people, property, and package. I'm assuming the credit and liquidity net worth of this person's good. Even if they're a first-time flipper, the property and the location is making up for the fact that they might be inexperienced. But what do we do as a lender when we get submitted something, and I'm looking at people, property, package, and the people have low credit, and the property is in a rural location, maybe not a strong market? Well, I can't change the people, I can't change the property, but I can change the package. I can change our loan. I can change the loan amount relative to the cost of the project. I can change our loan amount relative to the value of the project. I can make sure we have an acceptable equity barrier or equity buffer in loan to value, and I can make sure the borrower actually has skin in the game and is paying for hard costs out of their own pocket. And that's the best thing we can do. So here, I'll just pull up a let's just pull up a random. Let's go to Kentucky. Okay, I recently looked at a deal in Kentucky, and there are some good markets in Kentucky. You could be up here in Covington, Newport, Fort Thomas. You can be in some areas where I would consider really great real estate. But the interesting thing about Kentucky is you can get between Louisville and Lexington over here, and you could be out here in one of these towns. Let's say you're in Frankfort. Okay. Now this is not. I haven't done any business in Frankfort. It looks like it might be the Kentucky state capital. So I'm learning here with you guys, and some of you from Kentucky are probably chuckling right now. But let's take a look at Frankfort. I've never been here before, but as a lender, as someone who's investing money in debt opportunities here, I'm making loans. How am I going to approach a deal in Frankfort, Kentucky, when I don't know anything about it? How can I possibly get comfortable with making a loan here when I'm sitting over here in Coeur d'Alene, Idaho, guys, where do I live? I'm way over here. I have driven through Kentucky a couple times. Beautiful state. I definitely didn't drive through Frankfort, but okay. So the first thing I do when I'm looking at a new area is I am going to do what you guys might have noticed earlier. I'm going to look at population change. So I'm going to say Frankfort, Kentucky population change. Hopefully this simple Google search will give me what I need. Okay. Slow but steady growth according to Google, 0.16%. 0.02. Okay, so it's pretty flat. I'm not even going to call that real growth. I'm going to call that pretty flat. It's a 28,000 person area. It kind of looks like it might be connected to some other areas like maybe Lexington. Let's see how far it is. So say I'm doing a deal here. Let's just choose an address actually. Let's say someone's sending me this property right here. What is the address? Will it tell me? Tatato Trail. Let's see if we can grab an address here. 523. Okay, perfect. This is our new loan, guys. Someone's sending me a loan at 523. Tatato? I don't know. I'll have to Google that one later. How do I even say that? Tatato Trail. Tatato Trail in Frankfort. All right, here it is. Here's our new deal. 2,500 square foot home. We don't know when it was built. We even have some pictures. That's nice. 523. So now I'm going to look at, because this is a new deal, I looked at the population. The population is flat, so that's not a pro or a con. It's kind of a stable market, I guess. Let's see how close that is to the nearest employment center, because I always want to know for my end buyer, who's buying this house after it's been flipped? Where are they working? Why are they buying a house here? Is it the schools? Is it a popular destination for, is it a vacation destination? What is it? What's the story here? Well, okay, I can see that someone living here can commute 39 minutes to downtown Lexington. And we know that Lexington, let's see how big Lexington is. Lexington MSA population. Lexington is an MSA of 535,000 people. This is the total area. That means Lexington is the hub of a 535,000 population metro area. So that's not rural to me, actually. Although Frankfort itself is a little bit rural, it's not a big town. You can drive 43 minutes, or 39 minutes, sorry. You can drive 39 minutes to work at downtown. Maybe you work at the University of Kentucky Art Museum. Look at this. There we go. There is employment. This is a good sign. And even though this isn't, in the sprawling DFW Metroplex, it's still connected to an area where I would say it's viable for employment. That's good. And on a deal like this, if someone's submitting me this loan and they've got a decent borrower, a decent property like this one we're looking at, I would say this is a very solid 95% loan to cost market. I could probably get to 95% loan to cost here. If we have a weaker borrower, maybe it's 90% loan to cost. But what does that mean for your loan amount? What does that mean for your borrower? So loan to cost is purchase price plus renovation. That's it. There's also financing costs. We can talk about that another time. We don't include that in our loan to cost in our loan to cost ratio. So when someone says, Andrew, I'm buying something for $100,000 and I'm going to renovate it for $50,000, great. You have $150,000 of hard cost in your project. In this location, I would say I'll lend up to 95% of that hard cost. I'm going to lend you $142,500. That means you need to pay for $7,500 of the hard cost in this property. I think that's a pretty good deal. So you're bringing $7,500 down at closing, plus you have to pay for your closing costs. So your actual closing costs might be closer to $15,000, but let's just say $7,500 of hard costs, down payment at closing. That's protecting me. I'm pretty bullish on this area as a lender, as an investment manager for a fund. And yeah, I can see the connection. The end buyer is going to buy this fixed up home and they're going to commute. Either they, and Frankfurt's the capital. Like they're probably going to work here and live here and go to school here, but they can also drive over here to this area for employment. So that's great. That's how we look at loan to cost. And again, when we have people property package, we can't change people, we can't change property, but we can change the package. In this case, I'm saying I can get to 95% loan to cost here. I do want to take a look at maybe an area where I might have some more pause, where I might say, you know, this is a little bit too remote. And let's come out here to Carlisle. Okay, this is going to be a very different sort of, yeah, perfect. Yeah, this is a very different looking sort of area. So first of all, Carlisle, not the state's capital, and also not a very built out area. I'm seeing a lot of farmland. I'm seeing a small town. I'm going to guess the population here is, you know, like 600. Let's just see if it'll tell me on here. It has a population of 2,000. Okay, great. Carlisle, I can see, is a 54-minute commute. I still have Lexington, Kentucky over here. So I can see it's a 54-minute commute to Lexington. That's outside of what we want to be. We really want to see commutes closer to 30 minutes. We'll stretch to 45. If there's a good story, you know, it's a strong market and someone's 45 minutes from wherever their job is, that's kind of on the cusp, but we'll still accept it. We can, you know, we don't have to be too conservative there. Once we get beyond 45 minutes, though, we've noticed when you get to 50 minutes, 54 minutes, you really have to start thinking about, is this a rural area? Do we need to make adjustments? Because again, I'm trying to make good investments. The investments I make are in debt. So I want to make good loans that are going to pay me interest and pay off. I don't want any problems with something sitting on the market for 2 years, or, you know, if something does happen, having a reduction in my principal and actually taking a loss because I'm in a remote location where no one's buying houses. So this is interesting. Carlisle, first of all, Kentucky's beautiful. I mean, just see all this and like, just, I'm very biased. This is all beautiful looking countryside. But I need to be realistic. Are people moving to Carlisle? So let's just look really fast at Carlisle population change, you know. Here we go. Carlisle. Let's see what's happening in this tiny town. Okay, so it's pretty much flat. It is declining a little bit, but it's a town of 2,000 people. And I don't know if you guys caught this. The median age in the last town we looked at was 35. This has a median age of 49. So that means there aren't probably as many young families moving here. In Frankfurt, on the other hand, median age is 35. That's 14 years younger than over here in Carlisle. And that just helps me know, you know, are people moving here for jobs, for family, for raising families? Well, if your median age is 49, probably not too many first-time home buyers, right? Okay, so let's look out over here. Okay, so in this case, if someone brought me that same deal and they said, Andrew, I'm buying this for $100,000. I'm going to fix it up for $50,000. I want a loan. I'm going to say in this location, you know, I'm going to need more than 5% of hard costs covered. I'm going to need 10 or 15. Let's take a look at this. So you're buying it for $100,000 and you're going to put $50,000 of work into it. Do I feel comfortable making a $135,000 loan in this location? Maybe. Maybe if the values there are really strong and this property is going to be worth, let's say, $230,000, $240,000 when it's done, I'm going to feel pretty good at $135,000. So in this case, the borrower would have to bring 10% down. They have to bring $15,000 down. So they're going to pay $15,000 at the close of their loan to help purchase the property. We're going to hold back the full $50,000 renovation budget and disperse that to them as we go. So this is the reality of being a private lender and making loans. And being a broker, you have to think like a lender. You have to think, what is the lender going to like? Because what is the single greatest thing a broker can bring to their clients? It's creating a direct connection and direct feedback between the lender and the borrower, and making it so when the broker says yes, the lender says yes. When the broker says no, they're anticipating that the lender was going to say no. So that's the value you can bring as a broker. You can get really familiar with your lender's underwriting guidelines, and you can help set realistic expectations. I hope everyone understands, you know, if someone in Carlisle, Kentucky is sending you a deal, you've got to let them know, hey, that's going to be a little bit remote. You know, maybe if you're over here in, what was this, Paris, you know, less remote. You're only, what was that? Yeah, 32 minutes from downtown, and you know, that's a lot easier to figure out for a lender, a lot easier to get comfortable with the risk there. So, okay, well, I do want to move on past that and just talk about something else for a second, and that's the rest of the lending process. So we talked about submitting a deal to Joey Rush. We talked about order entry, how I look at people property package, some of the preliminary underwriting. Say everything checks out. I get feedback to order entry. Order entry is going to send to you my feedback. They're going to say, hey, our fund manager looked at this deal. He said it's a little bit remote. You wanted a loan at 95% loan to cost. You wanted that $142,000 loan. He said he can go up to $135,000. Does that work for your client? You go to your client. The client says yes. Now we've got a deal. We're going to resubmit that in order entry. We're going to change the number from 142 down to 135. We're going to get this thing into processing, and we're going to hit the ground running. The first thing order entry is going to do, once they have your purchase agreement, the budget, all the items that we talked about in that initial email, they're going to go order the appraisal. They're going to order title. That means get all the title work with the escrow company put into place so that we can close it. And as a lender, we have to make sure everything's buttoned down. So they're going to go to get title ordered. They're going to get the appraisal ordered. And we're also going to get our hard pull on background and credit, right? So that's the moment where we're doing a hard pull, and the borrower's really committing to this loan, right? Because now they're paying $500, $600, $700 to order an appraisal and get their credit and background pulled. Now they have a little bit of financial incentive to stay with you as the broker, stay with us as a lender. And now it goes into processing, where our processing team is going to work as fast as possible or as hard as possible to get this closed efficiently. We actually had a deal the other week, and I put this out on social, that we closed the deal in 20 hours. We had someone call us. It was like a Tuesday afternoon at 4 p.m. They're like, I need to close this deal. I was like, okay, do you have title? Do you tell me about the project? They said, yeah, we do. I said, okay, we can get it closed tomorrow. And we ended up closing the deal in 20 hours. So our team is set up to deliver quickly, but that's the important thing there. The secret of that story is that the title work was already in, and title work can take a title company a week to prepare, right? So as soon as you send something in and I get feedback, and this is usually 24 to 36 hours, and your client says yes, well, we're hitting the ground running and we're ordering title, we're getting that appraisal. Another thing is, if appraisal companies are taking a long time, we do have the ability to do our own internal valuations. Our team has that capability. We're experienced real estate investors. We actually think we know what something's worth even better than an appraiser does, because we have a financial incentive to make sure, right, we're covering our butt, that we're not just accepting, an appraiser's opinion of value. We have to get comfortable with the value ourselves, right? So, but we can talk about that later. If you've got an urgent deal, stop watching this, contact Joey. We'll get it done in a few days. It'll be great, but you have to have title ready, of course. Okay, so where were we at? We were at submission, order entry, preliminary underwriting. We get into processing, and at that point, your broker, you as a broker and your client, you get handed off to our processing team. Today we have Ernest Mendez, who's our lead processor, or the team lead on the processing team, and him and his team. What they're going to do is they're going to take a look at that appraisal when it comes in. They're going to collect all the entity documents, and they're going to send over a needs list to your borrower and say, hey, this is everything we need. And you are welcome to introduce your borrower directly to Ernest, and he can facilitate a very quick feedback loop there where we get the items immediately. Brokers can also stay engaged to kind of grease the wheels and keep things moving, which is good. We want to keep things moving because I think speed matters more than anything in real estate. So when you get an application accepted into our system, you should know that we think it's a good deal for us and we're going to get it done, right? If your deal isn't accepted and in order entry, we give you reduced leverage and your borrower's not able to do it, there's nothing to do, right? There's no deal to be made. So what we really have to do is once you've been accepted into order entry, you've got to go jump into processing mode. You have to go think about, okay, what does the lender need? What does Kogo need? How am I going to get it to them? And really, as a broker, let your borrower know ahead of time that we're going to need all of these things, right? It'll become very commonplace that, Kogo only lends to entities, right? So we need to see the operating agreement, the articles of organization. We're going to have to see, assuming it's an LLC, we're going to have to see their EIN, that's their electronic identification number, like a social security number. We're going to need all of these things in the file, so you might as well collect those from your borrower even before you have acceptance into our pipeline. You might as well start papering the file, and then the moment that you get accepted and your application is accepted into our processing pipeline, you can just send all of that over right away. We had a great string of closings a couple weeks ago. We kind of transformed the way we do originations. We have a new origination software, and I was just looking at some numbers with our director of operations, and he was saying, Andrew, all those loans, the average closing time was 18 days. And I thought that was pretty good. That's great. I want to get that down to 14 days. That's where we're trying to get to as a company, is 14-day closings to become our average, to become normal. and I'm excited to deliver on that. And we have the team and the technology in place to do that. That wasn't the case 12 months ago, but certainly, what was it, June 1st, when we rolled out this new process, this new technology, we've been seeing the results, and I'm very excited. That is my background, and I didn't give a bio, but I'm sure that's somewhere else. Maybe it's on our website. You can see my bio. I've been doing this for a little while, and I think I've got it dialed in on how to get lending decisions made quickly, get loans closed quickly. So we're talking about processing right now. Ernest and his team are going to get things processed. And at the point at which we are clear to close, meaning we've processed through everything satisfactorily, the appraisal comes in, we've reviewed the budget, we're good with the budget, the loan amount is confirmed, we're clear to close, title is now going to get in contact with the borrower, and they're already in contact with us. We're going to send loan documents to title. Title is going to arrange for the borrower to sign those docs. Usually these are purchase situations where the borrower's purchasing it, so there's a seller, right? So the title's going to get in touch with the seller and obviously get the selling documents all signed, and title's going to make sure that title is transferred into the borrower's name. Title's going to insure us as a lender. This is very important. As a lender, we can't do a loan. We can't make a loan to someone where title won't insure it. So actually, title has its own underwriting process. Usually this happens behind the scenes. 90% of the time, there are no issues. But every once in a while, title will have some issues. They'll say, hey, for the people selling the property, let me just verify that this isn't fraudulent, that the people who are selling it are actual the owners. I'm going to need to see their IDs. I'm going to need to get this notarized. I'm going to have to see some chain of title. And maybe that title company has to go into county records and spend another week digging through things to find chain of title because someone inherited it, but the paperwork wasn't done right. Now they have to go back and call up an heir of someone hoping they're still alive and and who can sign off on this thing. So title has to do these things. But basically, once you get clear to close from Kogo, we are in contact with title and we're closing in the next day or two, right? We get clear to close and boom, we're closing. And that's the way we like to do it. There's no reason to wait around. So we close it. Our fund, it's either Secured Investment High Yield Fund 2, Circle of Wealth Fund 3. Our funds that we manage, we're actually going to send a wire from our fund to the title company. The title company is going to receive that wire, and they're going to disperse funds to the seller. They're going to disperse funds to all the different vendors and like the insurance company, servicing company, all the people who need to get paid, and then the deal's done. And as a broker, one of the people the title company just paid is you, right? So you're getting your fee. And then at that point, for your borrower, this is where our relationship with the borrower really kicks off. Yeah, we have that initial 2 or 3 week sprint of loan submission and order entry and preliminary underwriting and processing and getting their deal done. But for us, the borrower relationship starts when they close a loan and we start to service it and we start to build a relationship with the borrower as they're renovating their property, as they're running into issues, as they're finding early wins or they're having early issues. We're there every step of the way with our own in-house construction draw team, funding them money as they go, right? They're going to go order appliance package for their kitchen. They want a new fridge, a new range hood, new microwave and an oven and a dishwasher, and they're going to say, I need $4,000. We say, okay, great, yeah, show us the invoice. All right, we're sending it to you, and that sort of cadence is really what builds the relationship between Kogo and our borrowers, and that's where we really get to shine and deliver great service. I'm really happy. Our servicing team is amazing. Lake City Servicing does a great job. And shout out to Heather over there who's doing an amazing job, really amazing job with our draws. But that's really the borrower experience. And then they complete their draws, they complete their renovation, they get all their draw money, and now they are listing their project to sell, and they get an offer, and now that offer, they go choose a title company, and that title company reaches out to us. We send them a payoff statement for our loan, and that loan closes. Someone, that sale closes. Someone buys that property. They pay off our loan, and now we, as Kogo Capital, we have more money to lend. Right? The deal paid off. Now we're going to go lend that to the next borrower, and that's really the full life cycle of lending. Man, this has been a sprint of me explaining things. I would love to know. I think we have the ability to do some Q&A here, but I would love to know if anyone has any, early, kind of questions anywhere through the process. I'm happy to talk about what is a rural property. I'm happy to talk about people property package. How do we calculate LTC? So let's let's hear from some people.
Okay. Lynn asks, can you show how you came up with the LTC running the numbers, please?
I would love to. All right, let's get my computer screen pulled up here. You know what? Let's do this one better, guys. Let's pull up some Excel, okay? Yeah, blank workbook. Beautiful. If you guys don't like Excel, you should learn to love Excel as a broker. Okay, so we have purchase price, renovation budget. If someone is buying something for $100,000 and they're going to put $50,000 into it, we know that their cost is, let's do some nice little formatting here too. Whoops. Their cost is $150,000. That's pretty simple. Now, lenders across the U.S. typically lend between 75% loan to cost and even up to 100% loan to cost, though the most common lender product available today is going to be 90% loan to cost. So I'll throw out 90% loan to cost because that's really the most typical, good people property package loan to cost that most lenders are doing across America is 90%. So although everyone advertises like 100%, and that's usually a small amount of their business, although we do a fair amount of 100%. Okay. Okay, so this is it, right? So we've got $150,000 of cost, and I'm just going to really quickly say what is 90% of that amount. I forgot to put a multiplication in there. There it is. That's our loan amount at 90%. Lynn, are you able to see this? Does this make sense? I am multiplying cost by 90% to get to a $135,000 loan amount. And really, though, I will take it a step further and let you know that just because you're hitting the LTC requirement, 90% LTC here. Okay, well, we should make that look better. You could also be limited by value. So just because someone's spending $150,000 on a project and they're putting $15,000 of their own money, so now we can see down payment, right? Down payment equals loan amount subtracted from cost. That wasn't double equal. Okay, so now we know that their down payment is $15,000. Okay. Yeah, so you still have to think about, is this valuable enough? So I hope this isn't confusing. If I want to make sure this is going to check $135,000 loan amount, I want to know that, hey, I know I need to be under 70% LTV. What I'm going to do is I'm going to divide 135 by 70% and make sure that my property is worth at least this. So this is going to be 0.7 to get to 70%. Did I say divide? I put a multiplication in there. So I know that the value has to be for 70% LTV. Yeah, value needs to be at least $192,000, right? So LTV and LTC, very common ratios. Get familiar with them, and that is probably the number one way we look at risk as a lender is we think about loan to cost. What is our loan amount relative to cost, and loan to value? What is our loan amount relative to value? Okay, let's move on to another question.
Okay, William asks, my understanding is that the interest on the rehab portion of the loan is charged from day one. Can we renegotiate the interest and have the interest charged after the funds are drawn?
Oh, great question. Yeah, so that's called Dutch interest. Most of our lending is Dutch interest. So that's 100% right. So in Dutch interest, your borrower is going to owe interest on not only the amount, well, this doesn't really work out, I'm saying, so let's change this up a little bit. We're going to break up our loan into two loans, acquisition loan amount and renovation loan amount. And the reality is it's one loan, but just to illustrate what the Dutch interest is that we're talking about, for our lending, okay, and we're going to divide that by 12. Oops, and divide it by 12. Okay, So in our lending, we do charge interest on the full amount because when as a lender, as a fund, when I fund $150,000 loan, even if I'm funding $100,000 purchase price or $100,000 of acquisition money and holding back $50,000 of renovation money, I'm actually advancing all of that to the servicer. So the servicer of your loan is holding on to $150,000 of our money, and we need to earn interest on that. For some loans, like construction loans, typically it is non-Dutch interest, and we're able to do that. Was that Willie? That is available for construction loans. Not something I'm publishing that we offer much of. I mean, in reality, I do that here in Coeur d'Alene where we're located, or parts of Texas where I used to live and run a family office lending platform similar to this. There are places we would do that. But yeah, no, all of our lending today is Dutch interest. As we grow and loan amounts get larger, it is possible to do non-Dutch interest. But on loan amounts under $300,000-$400,000, it's all going to be Dutch interest. And that's pretty common in the industry. But you can also find non-Dutch interest for your clients if that's something they're sensitive to. Just that would be, very possible.
Can you show how you came up with the LTC? Oh, wait, no, sorry, hold on. Just read that one. How much time do you typically need to close a DSCR loan?
Oh, DSCR is a great question. So our DSCR loans come from a bucket of capital that I don't manage personally. It comes from a partner fund. So what we do is we send those to really you can kind of keep it like a third-party partner, someone we have a good relationship, a good amount of trust with, and that's based on their timeline. They have a commitment to fund DSCR loans under 30 days. Keep in mind, they're not doing DSCR lending to anyone with a credit score under 640. They're looking at, very conforming, cookie cutter, single family residential DSCR opportunities. So I would say under 30 days. But these are, this is Wall Street money. This isn't privately managed funds anymore. This is a lot of this money is priced to publicly traded Wall Street bond market type of stuff. So it's a little bit different, and it's not as flexible as like a, family office private lender like us, where we're lending our own money. Our next question.
Let's see. So if the property is in the location, LTC would be reduced by 80 or 85% of the LTC. But what if you take into consideration the joint venture loan with premium student financing?
Oh, great question. Yeah, so something we do offer. Yeah, joint venture loans are really interesting. So 4 months ago when I came on board, what is this that we're doing? So we have students, and I'll just explain it for everyone, students who go through, master level education courses where they learn how to do different strategies. And one of those strategies is, hey, if you're a master level Lee Arnold system student, you find a deal that you like and someone needs financing, you can say, hey, I'll partner with you and we'll be able to do 100% financing. In those remote locations, no, we won't do 100% financing in that case. For those for those 100% plus, where we're funding 100% purchase price, 100% of cost, 100% of closing costs, those are going to be situations where people property package are all prime, and we have great people in great locations. And I mean, and that's like for me, let's pick on Dallas. You're over here in Dallas, and you're in let's choose Frisco. Where's Frisco here? Yeah, you're flipping a house over here in Frisco, Texas, right? And you're saying, hey, I'm going to flip this house right here. I can't even see it. That's how nice it is. It's behind a gate. So, maybe it's one of these. Hey, I'm flipping one of these townhouses here. Can I partner with someone, get 100% financing? Absolutely. Yeah, we'll take a look at that. We think the risk-adjusted return makes sense there, assuming that you are under 70% loan to value. So you're buying it really well, and we are so confident in that real estate market and the team assembled that we'll fund 100% of everything. That's not a problem. But yeah, that's just for premium students. We don't see as many of those because, but yeah, for those the people who go through the education and that we can do that.
Okay.
Sure.
So there is a question here that's saying 640 for a DSCR, not 650. What determines rural property? So I guess the
Sure.
640 credit score.
Yeah, two-part question there. Okay, so 650 credit score or 640, lender by lender. We work with a lender where we can do 640. A lot of lenders are 650. There are lenders who are 710. It just depends on the bucket of capital. Again, this is long-term Wall Street money. It's, these are 30-year loans, and people are very sensitive to, yield spread, and the way they get their yield spread is, the credit, same way we look at it, their credit boxes, people property package similarly. And they're going to make sure that those people have good credit, they have sufficient skin in the game. These are 75% LTV, 70% LTV loans. Some people will stretch up to 80, but let's talk about rural, because that's something that involves our funds and the decisions I make every day on whether we're going to lend in a property or not, lend on a property or not. And let's pick on beautiful Kentucky again. What determines rural? So our definition of rural that we use, and this isn't necessarily true 100% of the time in every market. You could be in Alaska somewhere and I'd be like, no, that's rural because, so Alaska's its own case. But generally, you want to be within 45-minute commute of a metro area of at least 200,000 people. That doesn't mean the town itself has to be 200,000 people. Like I think we were, where were we? Were we in Lexington over here? What is the Lexington population? Let's see, it's probably over 200 though. 330. Let's find a nice small city where the metro, okay, let's go to Coeur d'Alene, guys. Here we are in Coeur d'Alene. I happen to know Coeur d'Alene is not a city of 200,000 people. It has, city, Idaho, population, 58,000 people. Okay, but is it rural? No, it's not rural, and here's why. The CDA Idaho metro area is 192,000, and I'm going to say that's close enough to 200,000 people. Also, if you include the fact that it's, over here you have Spokane, and this whole area kind of connects, we can tell the story that, hey, this isn't rural. But where you do start getting rural, you can start heading up here, and you start getting rural, right? And that's how it is in every city. We want to be, just like we placed that marker, we want to be a 45-minute commute from jobs. Really, that's what it is. We want there to be a commutable distance to jobs for that end buyer of the home, and that's how we figure out remote. So wherever you are in the U.S., make sure that you can drive to an area where there are jobs. And how we define that, just broadly speaking, you need an MSA of 200,000 people. Next question, please.
Let's see. So we have I'm sorry, I just lost. What was the down payment figure for the percentage? For figuring out the percentage for the down payment?
Percentage for the down payment. Okay, good question. So a down payment is going to be, okay, we'll go back to that. This is kind of like another loan to cost question. We're going to say purchase price. Boop. Sometimes do PP, reno, and cost. There we go, 150,000. So it depends on what we're sizing the loan at. If we're sizing the loan at 95% loan to cost, here, let's just give a range of values here. 90%, 85%. Your purchase, your down payment. There we go. I'm going to have to adjust these cells. That's right. I move that up. I'm going to give you a down payment in just a second. So what I'm getting right now is here's the loan amount, and then the next column is going to be down payment. So let's trying to do insert a line here. Loan amount, Down payment. We're going to subtract the total cost from the loan amount, and this is always going to be your down payments is total cost subtracted by loan amount. Oh, I did that one backwards, sorry. There we go. So I hope this is answering the question. How do we get to down payment? If I'm lending 95% of total cost, I'm lending $142,500 on this transaction, and the down payment is going to be $7,500. And you can see how this carries down. So this is like a very typical kind of scenario in private lending today. Lots of lending across the U.S. gets done at 90%. Until you start getting really into those favorable metro areas where people are really bullish and you're in like an infill location, in Dallas or something. So next question, please.
Okay, so the next question is from Tom. For the premium students, does 100% financing include closing costs in addition to the purchase price and rehab costs?
Yeah, in infill prime markets, that is the case. Yeah. So they would get financing for. It wouldn't look like this. It would look like this. Oh, my shortcut's not working. I keep trying to add a row, but this is what happens when I'm on a laptop. Hey, there we go. It worked. Okay, 100% is obviously just, this. So your down payment is nothing. But on top of all this, you have something that's not. So you have closing costs. So you might have, let's say someone has a, 3% origination fee. Let's do this. They're paying 3% origination fee plus 3% broker fee, plus they have to pay title and escrow and everyone. And they're coming out with closing costs of, wow, $12,000. These are, that would be expensive. I think I'm being a little bit generous here. Hopefully nobody has closing costs that high. But in the case where someone is getting 100% of their purchase price and renovation covered, they do still have to pay their closing costs. Unless this is a JV situation where one of our students is doing a deal personally, then we can pay their closing costs too. And then in which case, let's do cash to close here. Okay. So cash to close is different than down payment, right? From a lending perspective, I have a down payment against the hard costs. Cash to close is the borrower-centric view. The borrower perspective is how much money do I actually have to bring to close? Well, they're going to have to pay title, insurance, escrow, whatever, servicing, their own builder's risk insurance, all that stuff, origination fee, broker fee. Okay, they have to pay all that. That doesn't protect me and my collateral as a lender. So I care most about this down payment column over here, but the borrower cares most about this cash to close column. And if a master broker, for example, goes out to market and they bring a deal to their client, they can say, hey, we can fund 100% purchase, 100% reno in this prime market. And that's actually what we did over here. We did a deal over here. Actually, the one in Denton, I changed the address for you guys, but there was a deal here in Denton that they did, and they did 100% loan to cost. And that was, so that's the case, right? Is we do that all the time, but they still had to pay their closing costs, right? So they had to pay $12,000 of origination fee and broker costs. Now, the premium financing, which is even greater than 100%, I call this one 100% plus, and I've never seen this anywhere. And I've worked at several other lending companies. It's kind of from a lender risk perspective, like I've got to really make sure these loans are dialed in and they're in good locations, because we might lend not just $150,000 of the total cost. We might also lend the cash to the closing costs as well. So we might make a $162,000 loan amount, zero down payment, zero cash to close. Well, actually, I should do this. This is the more accurate way. There are still closing costs. We're just covering them from the loan amount. So the borrower doesn't have to come into, circular reference, isn't coming into isn't coming out of pocket for those. So I'm gonna have to hard code that value. All right, next question, please. While I play in Excel, I can do this for hours. Don't want to get distracted. Loan amount. Boom. Okay. Well, we hit the hour mark. That covers our broker webinar for today. And I would love feedback on this. I'll go through comments and things and see what the general reaction was. And as always, if you want to reach out to us, you have Joey Rush, you have myself, you really have the whole team at your disposal. But Joey Rush today is our Director of Wholesale Lending. If you're a broker on this call and you have a deals to submit, you send it to Joey and he'll get you into the underwriting pipeline right away. Or the processing pipeline. I'll take a look at it and I'll give your loan a thumbs up or thumbs down very quickly so you know if we can approve it based on people property package in that area. Yeah, so thanks for joining us. Andrew Benton, Managing Director of Kogo Capital, signing off. Thanks for being here.